We don't yet have intro music, so I threw a little of the band up on Cripple Creek. I don't know if it came through on the microphone, but we need an Inside Edge intro song. Hey, Kyle, what do you think? Any votes of what may be the theme song?
That's a good off-the-cuff song, but maybe there's a better one. It's a good one.
I hope this market isn't. I hope this market isn't up Cripple Creek. All right. Hey, welcome, Todd and Kyle here. We're about a week and a half from the last one. We're settling into a routine of getting there weekly, and there's a lot of prep that goes into these reports. I mean, we've been working on this for days. I had to travel a couple days to New York City for an industry event, so but we are getting into a weekly routine, and we're getting closer than we've ever been. So happy Friday, Kyle. Hope you're well. What's going on, man? All good?
Yeah, happy to be here. It's
nice.
A good week. Got to talk to some new people from people interested in the business. That went really nice. So
yeah,
all is well.
A lot of interest for sure. It's getting busy, which is all good. So the structure we're doing here is we're going to start off the video. We're pushing the first part out publicly on YouTube, and then we reserve account specific and specific items as it pertains to the portfolios and planning for investors only. So we'll transition at the end of the video into the members only. So we are Todd Gordon, Kyle Wasson from Inside Edge Capital, and we have I think a pretty good session set for you here. So without further ado, let's jump into it. This is the market portfolio update for Friday, January 26th, 2024. Full disclosures can be viewed here, okay? So just to start, I'll start it off here. Markets are at all-time highs, and the NASDAQ was a leader. S&P has been a little bit of a holdout, and the S&P is now at all-time highs, which is amazing after being at significant bear market lows at the very end of 22 and early 23. Small cap Russell is not yet there, but not really a concern from where we sit. The Dow made a high, I believe even more than the NASDAQ did. So markets are at highs, and yet there's still a lot of concern out there. And I think in this video that we're going to make for you, we're going to share some of those concerns that we have. And we've been working so incredibly hard in this market. I know I have on the portfolio side. Now I know Kyle has on the planning side, just trying to look at, is this break to new all-time high sustainable? And are we about to enjoy a significant bull market, or are we set for a little bit of a false break and a retracement that we need to address? So jumping right into the gory technicals, and I generally try to keep this hardcore gory stuff that I do behind the scenes for the most part on the wealth management side, but I told Kyle, I said, I just got to be me. And you guys know the way that I gauge where we are in terms of early or late stage trend or correction or pending significant correction is a methodology called Elliott wave theory. And it's rooted on classic Dow theory. Charles Dow is really the grandfather of technical analysis. It's the same Charles Dow's Dow Jones Corporation, Wall Street Journal, Dow Jones Industrial Averages, et cetera, et cetera. And he basically gave us the idea that markets move in trends of 3 with 2 intervening corrections. The issue now is we do have, from that late 22 low, we do have 3 trend waves labeled with green 1, green 3, and green 5 with 2 intervening corrective waves. Are we going to see a correction on the way back? And there's a lot of work we're doing behind the scenes to try to figure out if we are set for a correction. And it's not something that we want to sit idly by. The correction could be 10 to 15%. And being that we're active management, we take that very, very seriously. And there's a lot of cross currents in the market right now. There's so much happening, and there's so much to sort of I would say shuffle through, or so much information to decipher. A lot of cross currents out there. It's incredibly interesting, really full attention is being paid on the investment side. Kyle, I know I'm hitting it hard in the beginning. Anything you want to add to this?
So I guess the theme today is like kind of looking at the squeakiest wheels in the economy, just seeing, are the fears valid, what's going on, and just trying to give some more information around each of those concerns.
Yep. So we'll jump in now. Do I feel like, as they said, we're going to go through the concerns that may trigger a correction in the first half of 2024. Now, am I gonna follow this to a T? Am I saying this is absolutely going to happen? Absolutely not. There's no infallible way to analyze market action or fundamental data or the economy. It's one school, and there's another scenario where it portrays a clean push through these all-time highs and a continued and significant bull market. I don't know what the future holds. Our job is to fully assess the now, use all available information, and put us on the best path for what the future holds according to the data now. It's kind of a fool's errand to try to figure out where the market's going to be in 6 months from now. Nobody knows. But all you can do is thoroughly follow your process and assess the now. And that's what we're doing. And I have a lot more to say about that, but just speaking to investors, we are watching very carefully, and there's a good chance that we are going to ease up the octane, so to speak, of the portfolio, take the aggressive factor, for lack of any technical terms that I could put in there. We may ease things off in the event that we do get a pullback. Not guaranteed, but we're watching really, really carefully. Okay, now a couple of the prospects that we've spoken to who are watching this video, Kyle. I told them we'd take them through this slide. If we do make a move to get defensive, yes, we've done it in the past. We've raised cash in both you hit the nail on the head earlier on a client call, prospect call. You said, even in our aggressive growth portfolio, we raised cash and we put an inverse ETF on to sort of buffer some of the downside. So if you want to take a look and stop this, you can go back and look at what we did in terms of raising cash and moving to an inverse ETF during the 22 decline, where we had the inflationary spike and the move up in rates. But we've done it before in the past, and if it happens again, we will look to cushion any of the downside. Anything you want to hit there? And I'm on a roll because I know we're recording late on Friday, Kyle, so just interrupt me, man.
Yeah, no, you're good there.
Okay. All right. So as Kyle said at the top, we are at market all-time highs, but there's a lot of things hanging over the heads of the market. And are we going into a recession? There's still 63% of respondents to this particular survey think we're going into recession with the stock market at all-time highs. It's crazy how that works. And from what we see, there's 5 main reasons that investors, both end investors like I guess my parents and your parents and investment professionals that see for a recession. So, anything you wanna hit here or dive right in?
Yeah, it's an interesting chart if you look at how sentiment either leads to a recession or maybe it follows a recession happening. So it's not like the gray horizontals are periods of recession in this chart. So you'll either see a spike before, sometimes it's after, sometimes you see a spike and there's no recession at all, which is what we're seeing now. Because if you look at the 2023, it's 62% of people, we're thinking we're going to go into a recession, but here we are and haven't seen one yet. So it's interesting.
And you made an earlier point that I thought you were going to jump on. You're like, the prior 3 recessions, about 25 to 40% of the respondents thought we were going into a recession. And you're like, where was the other 50 to 60 to 70% of them? And now
it's never 100.
Well, yeah, except for the 1980 recession, which I don't know what, that's close to 80 or 90%. Now, almost 3/4 of respondents think we're in recession. And where's the, first of all, where were you guys the last 4 recessions? And now, where's the recession? So I thought that was interesting.
They're the half glass full, or the glass is half full people.
or because, the frequency of recession, the frequency of, let's call it, market bubbles that have popped. We had tech bubble, we had housing bubble, we had a crypto bubble. I mean, it's happening more and more often. So I think people are assuming a recession. So these are the 5 main reasons that we're looking at: consumer confidence, consumers tapped, unemployment, housing market, unsustainable U.S. Fiscal situation, both on overall debt as well as budget deficits and yield curve inversion. So these are the 5 things that could trip up the market. All right. So number 1, drop in consumer confidence. Kyle, take it away.
Yeah. So looking at this survey, which is the University of Michigan Consumer Sentiment, people call it Consumer Confidence Report 2. Basically, when this blue line is high, that means people are confident about the economy, confident about the future, and their ability to spend and cover their needs. Same as in the other chart, the grays, vertical sides are the recessions. And what we saw most recently, you can see in 2020, pandemic came on, and then consumer sentiment dropped sharply and didn't recover really until mid 2023. Rates, easing, inflation easing, things kind of helped things rebound. But still, you're looking at very low levels, even with the recent rise. And if you go back to that May 23, it's the lowest survey result on record. So for there not to be a recession is pretty surprising.
And I can't help but notice, and we'll talk about it, but every significant spike low in consumer confidence, for the most part, accompanies recession. And we've had the low. So again, where's the recession? But as you put here, there's several things that can still lead to recession: high interest rates, student loan payments being resumed, excessive savings. We'll talk about that. I mean, the Fed may not cut as much as the markets are pricing. Still, Fed fund futures are pricing 5 rate cuts right now in 2024. So, that's another thing that they may not get. Number 2, recession reason, and it's hidden just behind my head. We'll try to format that better in the future. Recession reason number 2, consumers tap and unemployment is going up. Personal savings rate dropped to the lowest levels since the global financial crisis. So personal savings rate, we're at 3.7%. So all those stimulus checks that people got, and as people started to, tighten up their personal balance sheets at home during the pandemic, well, that's come off with a vengeance. So is the consumer tapped? And you could read the definition there of personal savings if you like. Consumer debt, talk about this on credit cards.
Yeah. So just showing consumer debt, as you can see, it's going up over time. Actually, people saved a lot at the beginning of the pandemic. There's a dip there, but it's continued to go back up since then into 2024. One thing, I guess, not really a reason for recession, but one thing to kind of keep in mind with this number is that this graph is nominal, so it doesn't adjust for inflation. We have a pretty interesting slide showing debt as a percentage of income that we'll get to in a little bit.
We'll get to that. We'll get to that.
I think when people read the news or see a headline about consumer debt and I mean, look at this number; it's over $1 trillion, 1,000 billion. So that's really high, and it's definitely a cause of concern, and it will be a cause of concern in the scenario where unemployment goes up, because people are not going to be able to cover their debt payments as well.
You're jumping ahead.
So
Hold on here. We got a lot to come out.
Yeah.
We got a nice story to tell you.
For sure.
So the other thing on recession reason number 2, consumers tapped, unemployment going up. Like I've got to cite a video that a friend sent me, which is the bond king, Jeff Gunlock. I mean, he's sort of dethroned the former bond king, Bill Gross. I think they're in like a bond king sort of squabble between the two. I think they're even calling each other names, like decabillionaires calling each other names, like who's the king? Like, okay, get a life. Trade equities, man. No, I'm joking. But anyways, he put out a video saying, kind of pounding the table on recession, and I'm gonna sort of cite this video a little bit as we go through. But he's saying that a move higher in unemployment usually precedes recession, and we're getting news of pretty significant corporates dropping employees. Microsoft today let off 1,900 following the acquisition of Activision Blizzard, which took forever to get through UK antitrust courts. And then last week, BlackRock, major ETF financial shop, huge, cut 3% of its global workforce, right? So is unemployment going up, right? And the point here is in green is recession. So, sorry, in green is unemployment, which usually accompanies recession, which is in the gray. Okay, so just focus on gray and green right now. Gray is the recession, green is the unemployment rate. You could see how low the unemployment rate is, but is it ticking up and does it precede recession? Number 3 reason that markets are afraid is the housing market. It is, what was the stat you gave me earlier? U.S. existing home sales slowest in 30 years.
In 30 years, yeah.
Pending home sales, same deal. I mean, just right on the lows. So, obviously this is a nuanced conversation with, we'll talk about several different things going on here, but yeah, on the surface, the data is being reported, existing home sales, the lowest in 30 years. There's a lot of sticker shock to that, okay? Number 4, the U.S. fiscal mess. And we debated putting a better name on that, a little bit more professional, but there's a lot of concern with the debt, $34 trillion that the U.S. has accumulated. On the surface, when you start to look at the amount of money that the U.S. government is paying to service that debt, combined with interest rates that have gone up 525 basis points in less than 2 years, it's a historic increase that sharply increases the cost to service that debt. So net interest costs right now reach $659 billion, which is 2.5% of GDP. 23, $184 billion increase. Interest is now the 4th largest government expenditure behind Social Security, Medicare, and Defense. Now, this is from the CRFB, which Congressional Research something board. You can find it, but the net interest. You're shaking your head. What is the CRF?
I don't forget.
Oh, look at that. Committee for Responsible Federal Budget.
Yeah. It's an oxymoron.
I was just going to say that's an oxymoron. Yeah. So the net interest margin, the service is going to be right here, net interest in red. So right now it's rolling at about 1 to 2% of GDP, but assuming, I believe this is assuming the interest cost stays the same, it's expected to exceed non-defense discretionary in sometime in 28, 29. Where's defense? Defense in blue. It's actually going to exceed defense 2026, 2027, and even Medicare and Social Security. You're talking 2020, 30 years out. So, this is concerning. And on the surface, people are becoming very, very concerned on this. This is going into the deficit. Reason number 4 again. federal deficit down to 1.7 trillion. You know, we have 4.44 trillion in revenue in 2023. We spent 6.13, and that leaves us in a 1.7 deficit, trillion deficit. Now, of course, a lot has gone overseas, right? A lot has gone overseas, and there is some other spending. It's a little bit of a, you know, it's a special in the worst sense of the word. It's an exception, of course, but you know, this is a concern that markets are having. So right now, the federal deficit as a percent of GDP is running at about 6.3%. So it started to tick down since this chart's update. You can see for comparison where the federal deficit is as a percent of GDP. Of course, it wasn't anywhere near as bad as it was back in World War II. But this is, you know, coming from the COVID lows, the worst it's been, obviously, since World War II. Take us away here.
Yeah, just showing that point in another way. This graph, it's showing, you can see the black line towards kind of the top of the red part. That's our total receipts. So everything we're bringing in. The blue line is the total spending, the one that's kind of up at the top, and that's kind of the difference between the red, blue, purple, and green. The white area is our net interest. So just showing the same figure in a different way, but that net interest, it's compounding basically in a bad way, because all of the other spending as an aggregate is staying at the same amount of our GDP. So basically the projection is we don't spend anything more on anything other than interest, but our deficit continues to go up because we're on the wrong side of the compounding, where you're paying, where you're taking out debt to pay for your debt, you get in a negative compounding situation. And so I had to put the point in. I talked to people about their own personal financial plannings. Now I'd like to talk to Biden and everyone else. When the projections don't look too rosy, you know, it's time to develop a new financial plan, make something better where the committee for a financial responsibility can put something out that looks financially responsible. So,
you know,
I think that yeah.
Sorry, go ahead. Didn't mean to interrupt.
It's just creating, you know, the future projections like this. It does create a lot of anxiety about the you know, the future and our ability as a country to function smartly. So
I want to look more into this. Like, what kind of growth rate are they projecting in the GDP, you know, as we go out? You know, personally, I'm bullish on the market. We'll talk about it. You know, we talked about a longer term, a shorter to medium term pullback, but what kind of GDP growth rate are you putting in? I mean, are we truly going into the next exponential, you know, tech-led AI age that's going to transform a lot of industries? Like, what, you know, if you look at this, look at the scale though, Kyle, and I just want to push back for a sec. Like, okay, 25, right now we're rolling 22, 23% of GDP for total spending, 22%. So this line is steep, yes, but I mean, okay, so we would go up to 30 to 35 in the next 25 years, 30 to 35 from a base of about 25. So, right? So,
yeah. And that's part of it. Like, this is a projection. This is, I mean, look at 2023, even through 2030, it's very much in range with 80 to 2000 or so. Right. And then that's when kind of the compounding and this future projection, the compounding starts to work against everyone, like in 2030.
Yeah, I hear you. But I think we shouldn't lose sight of the fact that this, so you're going from 22, 23% of GDP by 2040, which is 16 years out, you're looking at 30. So 6 to 7% additional percentage points of GDP is what, you know, for what we're immediately concerned with. it seems to be with and I don't want to get ahead because we're still in the top 5 reasons why we're going to recession. I don't want to get ahead,
Right.
but you just got to look at the scales, and you got to, you got to just get over the sticker shock of what a lot of people are putting in front of you. My point is, and we're gonna show you these 5 reasons that there's perhaps a different way to look at it, but that's just something that came to mind even before we prepped for this call, and I don't think that's an insurmountable task with what I think is ahead in growth. But anyway,
Yeah.
number
Certainly
5.
not right.
Yeah. Recession reason number 5 is the yield curve inversion. And if any of you have been following me for any period of time, we've been watching the yield curve like a hawk, which essentially is the difference between the yield on the 10-year U.S. Treasury note and the 2-year U.S. Treasury. Typically, the 10-year yield is higher than the 2-year, and that's what they call a normally shaped yield curve. When the 2-year is higher than the 10-year, it's inverted and recession is expected. And the time when 2-year is higher is generally when the Fed raises short-term rates. And the Fed will have an impact on the shorter end of the yield curve, which is 2-year treasuries and less. The market forces have control of the longer end of the yield curve, with the exception of about a third of the underlying treasury supply, which is controlled by the Fed, which is quantitative easing and quantitative tightening, but a little bit different aside. So the Fed will cover the short term, and when the Fed pushes short-term rates up above long-term rates, they're trying to cool the economy down, and that's what's happening now. But real quick on that, and again, we'll jump in ahead, but you know what? I'll save it for this. I'll save it for when we circle back on this. So those are the top 5 reasons that we're going into recession. So are we definitely heading into recession, and should we lighten up stock exposure? Right now, there's a story behind these 2 dogs. I thought this one looked more confused than this one. Kyle wanted to put the Doge dog in on the Dogecoin, if you know crypto. So I was a nice coworker. I compromised and I said, let's put both dogs in.
Had to go for the more memeable dog.
So to recap, the 5 reasons that we're headed for a recession, supposedly: drop in consumer confidence, consumers tapped out, unemployment going up, housing market decline, unsustainable U.S. government fiscal status, and the yield curve inversion. Okay, so let's take them one by one. Drop in consumer confidence. Okay, the lowest. Go ahead. You want to take this one? Go ahead.
Sure. Yeah. So like we said, lowest reading of 50 in June 22, 51.7 was the next in 1980. We expected to see a recession with the drop. You would think, but we had the drop. Now confidence is rebounding, and we still haven't had the recession. Part of that, I think, with the Fed response and really the response in 2020, there was so much stimulus that happened. There's definitely a strong argument that just kind of wiped out the period where we would have been in a recession. But I think the point here is, for where we're at right now, does it go up and we don't see a recession? Is it like early 1980s where there was a short recession in 79, 81, and then another one, 83, where you saw an increase and then it go back down? It's hard to say, but, you look at these indicators for kind of a head start look. If you look at any, pretty much any of these, you'll see that tilt back down before the recession kicks in. Yep.
Yeah. The 2 things that really stick out, as you said, I can't really see a point here where there was a significant drop in consumer confidence that wasn't completely encompassed by recession. This is the most significant drop we've seen since the 60s in consumer confidence that so far has not labeled recession. And one thing that I just remembered, I went back and I have a screenshot here for the NBER, which is, the organization that labels us in recession. What's the typical look back period for, could they go back and put us in recession in that? We're past that point of no return at that point. So that's the first thing. The second thing is, put that in context. The COVID lows, consumer confidence was worse than 2008 when we almost lost the American financial system. You realize that? Like, that's how bad it was in '08. We almost lost the American financial system because the insane amount of leverage bets on the housing market that were being traded around on bank and investment bank desks. So, I mean, that's how bad it was, and yet we still haven't gone into recession. Now, keep in mind, the first 2 quarters of 22 were 2 contraction quarters of GDP, but they kind of redefined the definition of GDP. So, yeah, I also think we also went into recession, but they're just not labeling it that. Consumer confidence has come off the lows, as we just showed you. So we're certainly clearly coming off the lows. We're at 64 in Jan of 23, 69 December 23, and we just hit 78, right? So a lot of reasons that consumer confidence has come back, namely the wealth effect. You got to love when the stock market's at all-time highs. Inflation perhaps is transitory, as Powell said it was, and he was really taken to task saying it would be transitory, but it really has come off as fast as it went on. Increasing wage income, lower oil prices, all good stuff, you said here. Talk to us about retail sales, Kyle.
Yeah, just came back in for December above expectations. So people out spending, sales were 0.2 over expected. Consumer being such a huge part of our economy, our GDP, I think it's 21% or so, something like that. But it's when you see these numbers start,
consumer spending, the economy,
yeah,
I think it's larger.
Like,
I think it's larger than that, but okay.
Anyways.
Yeah. Okay. Yeah.
Yeah. So, you would see this come in below expectations. If we were seeing recession anytime soon, you would probably see this first. It would be one of those leading indicators.
Yep. Agreed. And we just saw first reading of advanced. So first of 3 readings of Q4 GDP. It just came out the 25th. Today's the 20th. So this was yesterday. Came in at 3.3%. Expectations were 3. A huge beat in Q4 GDP. Like, they were looking at 2, and this number will be revised because there's going to be 2 more additions of, 2 more releases of Q4 GDP to finish up 2023. They will be revised, but that was a really, really big reading. So recession reason number 2, the consumer's tapped, unemployment's going up. Our buddy Jeff Gunlock, which again, I have a ton of respect for him. I'm not picking on him, but he was pounding the table that unemployment goes up and will accompany recession. Well, if you look at what's going on with the layoffs that are making the headlines, and if you are a headline reader, why are they being laid off? Well, I mean, it's duplicate positions with Microsoft and the Activision, but it's also technology is displacing a lot of workforce. BlackRock cuts 3% of global workforce. You read that headline, you're like, uh-oh, but then you look inside of it. And perhaps the most profound new technologies are poised to transform our industry and every other industry. The world's largest asset manager said it still expects to have a larger staff by the end of the year, even with the cuts. Like, what? Like, how misleading is that? So there's 2 things. Like, technology is going to displace workers. Unemployment will go up. But one of the main reasons that we're seeing such a significant rally in the stock market is the computing power is getting significantly more powerful, increasing efficiencies, increasing margins, increasing profitabilities of companies. I hate to say it, but we want unemployment to go up because companies are going to be able to run leaner and produce more profits. I feel, dirty saying that, almost like the Fed says they wish they'd see unemployment go up a little bit. But to say that is going to lead to a recession, maybe, but while retail sales continue to be strong, while the consumer spending, while earnings out of companies are continuing to be good, and and technology, software, and semiconductor stocks continue to go, this trend is only going to continue. So I wonder if the traditional unemployment accompanying recession is wrong, where unemployment going up is showing that companies are adopting this new technology, and we're going into the next, as I said, tech boom, which they're calling the exponential age. Talking about the consumer. So this is, we're looking at is household debt. Is the consumer tapped? Household debt to GDP. It's been declining since the GFC. I mean, it started to stabilize here in the last couple of years, but we've clearly been in a downturn. Household debt to America's productivity. The consumer's tap, unemployment going up. Let's take a look at inside the consumer. Mortgage debt, payments as a percent of disposable income. How much money is left over and how much is going into mortgage debt? Clearly on decline. Consumer debt as a percent of disposable personal income. Not as sharp of a decline since 2008. And you know that the housing market has been cleaned up a lot since the GFC, but certainly off the 2000 highs. And household debt payments as a percent of disposable personal income, I would say looks closer to mortgage debt. So I don't buy it that the consumer is not in good shape. I don't buy it. Recession reason number 3. Remember that scary graph on housings, new home sales, existing home sales at 30-year lows? Well, what's behind that? Existing home sales in purple is down to a significant low that is at same as the housing crisis, global financial crisis lows. Well, why is that? Housing inventory has plummeted. There's no homes available. At the same time, we are in a bull market. It's a function of scarcity of housing, but also we have a strong economy. Housing prices are through the roof. So, of course, housing sales are going to be at new lows. Look at the home builders. Look at XHB. Look at Toll Brothers, Lennar, Pulte. I mean, these stocks look like tech stocks. They're ripping. I mean, now that supply chains are easing up and workers are going back to work, we need to be building more houses, and these home builders are managing their inventory and their build schedule very carefully, but these companies are printing money. So on the surface, you're like, okay, well, home sales, 30-year low, recession. There's more to the story. Second part of this is the banks are sitting on exceptionally high mortgage rates. The 30-year fixed mortgage rate is determined for the most part by the 10-year U.S. Treasury note yield. It's kind of weird how that works, but you can see the correlation between 30-year fixed mortgage and the 10-year Treasury note yield. I mean, it's spot on. There's always a spread between the two. Okay, the 30-year mortgage is usually higher than the 10-year, but this chart down here shows the spread. And the spread of about 3.25% was the highest level since 1985. So this is something we looked at. And I said mortgage rates can't get any higher because the 10-year yield has begun to roll over and the spread between that has begun to narrow, and the 30-year fixed mortgage is starting to come down. So if rates can continue lower, that's going to bring 30-year mortgage rates lower. That's going to bring more buyers to market. That should open up the supply of houses on the market and encourage builders to put more out there, and that'll stabilize housing numbers. Yep. Okay, this is a nice little aside. Speaking of mortgages and housing.
Yeah, so just looking at, we talk to people all the time who would love to move, and a big part of the hesitation is that they're currently paying half of the interest rate. Assuming they're financing, their mortgage right now is like half or even a third of what current rates are. So they're just not putting their house on market. They're not moving, or they're renting, deciding whether to buy, and waiting to see if mortgage rates go down. So this has been topic of a lot of conversations past, well over 6 months, and just, shedding some light on what kind of how we make that decision. You have to look at the future. And if you look at the projections this year, maybe not going to see the most relief in interest. We think they'll go down a little bit. Most analysts say rates could stay, they're like 6.5% 6.7 right now, or 6.6 at
Yep.
the end of the year. People are saying, like Fannie Mae, the biggest companies in that sector are saying like 6% this year. So maybe assuming yields stay the same and maybe that spread goes down a hair, kind of like it is now. But again, when you are answering that question, we think it's very specific. We think the answer is based on not only like your area, how long you want to live there, but like what kind of investor you are. What's the opportunity cost of financing versus doing whatever you're doing with your portfolio right now. So really, it's a custom answer if you ask us. But like generally speaking, if rates are where they are now, say you're a balanced investor, we'd probably go more into how long would you plan on staying in that house. To answer that question, if you're staying over say 5 years, that's probably long enough for rates to go down and you refinance. You're like at a better rate, and then also you don't have to worry as much about like not gaining principal if you are renting. But as far as buying and selling, I mean, I know tons of people that are just, they'd love to move, but not if they're financing.
And then we could do that. We could do that. I did that for myself when I refinanced this. It's what's your time frame for being in the house, but then what's your break even, including closing costs at the new rate, and to figure out, is it going to be worth it to actually do it, right? There's 2 steps to that.
For sure.
Yeah.
For sure.
Nice. Okay.
Yeah. So more on that. We think, from an investment standpoint, if you're a conservative investor and you are, I guess, in a position where you could put more money down and limit your mortgage, limit your debt, saving 6 point whatever it is on interest as a conservative investor, if the alternative is like a money market, say, we definitely recommend putting more money down, and the math would back that up, while, an aggressive investor with a long investment horizon, not touching their investment money that they would be going towards the house, would probably be better off from an opportunities cost standpoint of financing more at the 6%, knowing you can refinance later, and just investing the money that they may put down for the house otherwise.
And Kyle, I don't want to throw you off, but like thinking about what you're saying. So if the idea is to finance a house at 6%, yeah, it's a lot, but we'll talk about the real cost of capital in a coming slide. Compare that to a 5.25 1-year treasury. Okay, on the surface, that sounds nice, but 1, you got to pay tax on that yield. 2, you're losing, right, 3% in inflation. So what's your real return on that? Right?
Yeah, absolutely. Yeah, and it's
and
there's
the
a strong
inflation,
argument.
if inflation continues, you have a good chance for house appreciation.
Yeah, absolutely. And then opportunity cost of I mean, if you have a house you're considering selling and buying, that's one thing, but cost of, if you're renting, then you're not putting money towards your equity either.
Good points. Good points. Okay, this is you. You gave us a busy one here. There's a lot going on this one.
Lots to digest. Yeah, I mean, it's a big debt. So
and this is back to, hold on, let me just reset the tone here. This is back to recession reason number 4, the U.S. fiscal mess. That was a nice little sort of aside that Kyle did on the housing market.
Yeah.
But this is back to recession reason number 4, different reason to look at it, a different way to look at it.
Yeah. Wanted to throw one planning aspect into the slideshow today.
Well done, sir. Well done.
Yeah. So going back to the net interest that we were saying, it's compounding and it's growing, and we want to make sure that it's manageable. And when you look at that chart, it just seems, and like all of it's being lost. Well, the majority of the net interest on the U.S. debt goes back to the U.S. So about 76% of it is owned by either U.S. individuals, corporations, and the government. The chart with the pie, you can see the all the two blue sections are both U.S., and then the two orange ones are like the Social Security Fund and then other intergovernmental agencies. And then the green, about 24% there, is the foreign owners of U.S. bonds. So pretty manageable foreign slice. And I think, like, if you read about the U.S. debt, you're reading a lot about how China owns all this debt, how Japan has a ton as well. But really the trend is actually going down a little bit. So
they definitely decreased their holdings. Russia used to have a bunch. They sold that 10 years ago. It's going down. But Kyle, if 76% of the interest, which is $650 billion being paid now in interest, and that's one of the main reasons I want to pull this together. I'm sorry to interrupt, but one of the main reasons for volatility that we've seen at the end of 23 and in early 24 was the unsustainable fiscal deficit that we're running, as this margin that we have to pay, or the interest rate that we have to pay in the debt, is getting so large, and the Fed is forced to cut rates, or else we can't afford the payments. Think about that, though. 76% of the debt is held domestically, which means there's a lot of tax being paid on that money going out that's coming back to the U.S. government, and the money that's being paid on interest maybe is being reinvested back in the economy.
Mm-hmm. Yeah. And rates, Americans, if you exclude the government, they receive more interest than they pay. So a high interest rate, it's not the worst thing, even though it does usually come with some inflation and some GDP affecting it and slowing it down potentially if it overheats and stuff like that. But
good points. Very good points. Yeah. Keep going, brother.
So this was a nice one. It's not so much on the debt, but looking at total foreign assets, and this chart is the net foreign assets of the United States. And it's kind of hard to see, the numbers are light gray, but basically the difference between our external assets and our external liabilities. So foreign investors buy and hold U.S. assets like stocks, bonds, etc. Americans also hold a ton of international assets. And this is the difference between the two. It's gone back and forth since started reading. It's currently positive. So really, this is saying that America owns, more assets than other countries own American assets.
And this includes both private and public sector. That's the key here, right?
Correct. Yeah, absolutely.
That's interesting.
It just shows kind of the interconnectivity of the world too, I think, in a way, because it's there's so much overlap now with just the type of financialized system we find ourselves in.
Yep. Interesting. All right, I'm going to go back and push back on Gunlock a little bit. So he's saying federal interest expense, and this is very much related to what Kyle was just saying. Federal interest expense as a percent of federal revenue compared to the 80s and late 90s at 14% or so. Right, so this is, again, small numbers, 60s, 70s, 80s. We went from 8% federal interest expense as a percent of federal revenue, 8% up to 18% in 1980. He's making the point that, look at the sharp rally again. Here we go again. Wow, boy, why wouldn't we get back up to 18% federal interest expense as a percent of revenue? Okay, and then he puts it in a different light, and again, we'll make this PDF available if you want to zoom in and see it. How much interest the U.S. pay on its debt? This is as a percent of GDP. And this is really small, but it's like 2.5, 3, 3.5, 4, 4.5%, 5% interest as a percent of GDP. And he's saying the same thing. We're spiking. How is it not going to stop? Okay, we got to talk about the real cost of money and the nominal cost of money, which is interest rates, right? So if you look at, in blue, the 10-year yield, we've talked about that a bunch. It just went up to 5%. Now it's around 4%. That's the key driver of most of the interest rates that make up the American economy, consumer loans and credit card loans and auto loans. And that's the key barometer of interest rates and mortgage rates. But you also have the 10-year expected inflation. And interest rates trade as a function of future expected inflation, right? And you can see the correlation is just airtight. But what you'd notice is the blue, which is the nominal treasury yield, just made a new high, where 10-year expected inflation just topped out. We're at 2.16 expected inflation. That's the Fed's target. So it's the concept of what the nominal yield is and what expected inflation is. And when you look at how much you're borrowing in the future at certain nominal rate, you have to take into effect inflation, because if you're servicing that debt with no inflation, that's what you're paying. But if you're servicing that debt with some degree of inflation, it's actually cheaper to service that debt, right? So this right here is U.S. real interest rates. That is your 10-year nominal yield factored into expected inflation. We have been kind of topping out here at 1.6%. The 10-year nominal yield you read about in the newspapers at 4%. Factor in inflation, which is expected in the future, which is calculated by the central banks, our central bank, our Fed governors, is 1.7%. Okay, so again, Gunlock is trying to pound the table on recession and saying sell stocks because of this escalating move that happened in the 60s and 70s, increasing the Fed servicing their debt as a percent of GDP and federal revenue. But what you have to look at is the real cost of money. People are making analogies of the 1970s to today, and it's totally different. Inflation was rampant in the 70s, but nominal interest rates were significantly higher. Rates were 15, 17, 18%, but your inflation readings were at 8, 9, 10%. Your real cost of money is calculated by taking your Fed funds rate, which is your short-term policy rate the Fed sets, subtract core CPI. That is your real cost of money. When you factor in how much you're paying versus how much your payment that you have to make every year is being inflated away, which as a debtor, that's a good thing. If we're borrowing money and paying on that debt and we're paying 3%, but it's being inflated away at 2%, our net cost is 1. It's good. If you're a creditor, that's not good because you're being paid back less. You're being paid back with weaker money. Well, the real cost of money back in the 70s and 80s, as Gunlock is making that point, is 7, 8, 9%. Right now, we're at 1.5% real cost of money. It's totally different, and that applies to the Fed too. So, when they say like, "Oh, wow, we are the nominal cost of how much we have to pay on that debt," yeah, but you have to look at the real cost of money going out. And there's a different slide in here too. A ton of the outstanding debt that we owe is going to be refinanced, right? It's going to come due. And they're going to say, well, it's issued at 1.5% when the government sold this debt. But again, same principle applies. They're going to monetize the debt. They're going to inflate it away. It's already getting cheaper, and they're going to continue to do it. I think they're going to drive inflation up. I think they're going to try to push the dollar down, which pushes stocks higher. Combine that with what I think is a significant technological innovation that spreads across all industries. Yeah, we might go into recession, but I think stocks go higher. PCE, personal consumption expenditure, just came out today. It was a component of GDP. It's at 2.6%. Inflation has come off as fast as it went on, right? So the Fed, I don't think, has an inflation problem anymore. The yield curve. Let's pull this home here. Another reason that a lot of Fed watchers and prominent economists and money managers say we go into recession is because when the yield curve, which again is that 10-2 yield curve coming out of inversion, right? When it's below the red, we go into recession. And what they'll say is, well, look at this back in 2000, look at it back in 2007 and 8. We went into recession and the stock market in blue fell sharply. Yeah, but that's not the whole story. 2000 and 2007 were much different markets, macro markets, than we're in now. Yes, we have pretty significant yield curve inversion. We do. There's red right here. But one, it's coming out of inversion. And two, if you look at all the times we've come out of recession, or sorry, we've come out of yield curve inversion, which this amount of time, so we're looking at 8 times occurrences coming out of yield curve inversion, 5 of which led to recession. What are the 12 and 24-month returns of the S&P? If you look at all of these dates that I've highlighted, the 1-year return of the S&P is 11.25. 2-year return is 6.6%. If you look at the real yield curve, okay, the real yield curve, you factor in expected inflation at the 10-year level and expected inflation at the 2-year level. Same thing. Here's the real yield curve, which has come out of inversion. And there's been 11 times that the 10-2 real yield curves come out of inversion. Here are the 1 and 2-year stock market returns, 13.9 and 22.3. So, you know, and those are the two comparing each other, right? So, like, if you think about it, a lot of people are pounding the table on recession. And I think we just showed that 5 reasons why recession may not happen according to what's being reported at the headline level. But even if it does happen, yield curves coming out of inversion, we have historical precedent to show that the stock market is still positive. So I think it's either, you know, okay, if we pull back a little bit, I still think in the back half of 24 we rally and then we continue the significant ascent. If not, we're going to continue the significant ascent. So we're watching closely, but I think there's more to the story than what's being reported at the headline news level.
Yeah. Yeah, we're always looking for the squeakiest wheels and see what's coming unhinged or undone, and yeah, just see if it's valid concern or not. It goes a long way. Yep.
Anything you want to hit here? We're coming up on a long 56 minutes. This is a big one.
Yeah. Yeah, a lot of words on this one. I think, you know, we could boil it down and just say it's important to make sure your portfolio is inflation protected, it's inflation ready, it's inflation proof as it needs to be given, you know, your personal inflation rate, because at the end of the day, we're talking about headline numbers, but everyone has their own personal inflation rate too. So that kind of goes into how you invest and you know how you should set up your portfolio.
Yep, very nice, very nice. And this was an interesting point. Kyle's making the point in here that, you know what, higher levels of interest rates kind of shake out, and he makes the point of burning the dead wood, kind of getting rid of the excesses. I think Warren Buffett put it that, you know, when the tide goes out, you see who's been swimming naked. Sort of the same idea.
Yeah, exactly. So couple of headlines in here. The China had a bank, a shadow banking giant. I forget the amount of assets they had, but just basically filed for bankruptcy and totally foregoing the opportunity to restructure altogether. So speculative shadow bank just got wiped out, and it happened in the U.S. with those few banks last year with Signature and Silicon Valley and them, where they were all once valued at $550 billion. Yeah. So, you know, in periods like this, I think if you are looking for high yield or looking for yield, you know, you definitely don't want to be in the financials that really get threatened by interest rates when they go up. And then what we saw with Credit Suisse failed and got bought by UBS in a government brokered deal where some bondholders got wiped out, and the stockholders, the shareholders, got I think 1 share for every 20 or 22, I think, don't quote me, of UBS, and then the senior bondholders were actually rewarded. So just really, I mean, I don't think many people watching here are in junk finance bonds, but Credit Suisse definitely wasn't junk status before the kind of the systemic issues revealed themselves. But, definitely be careful if you are buying individual bonds, and then just kind of think about rates as, like you said, they're getting rid of some of the deadwood, the kind of the unproductive assets in our economy.
Yep. Yeah. Well said. Well said. Okay, we're going to leave it there on the public side, and we're going to quickly roll into. I was supposed to show you that blank side. We're going to quickly roll into speak to the investors here. And thank you for watching. If you hung in with us, I really appreciate it. We hit a lot on that presentation, but I think it was important to go through those big five headline recession causing sort of factors and maybe look at a different side of it. So Kyle, thanks. We'll pick it up next week, and let's jump into the member investor video now.